So this is the agenda. We'll be hearing a little bit about the Founder Institute, who is putting this event together. We'll then hear from Adrian Bunter, who is a very experienced angel investor. Jonah Ng will be then giving us her perspective on what is an investment thesis, how do various investors decide what to focus on or how to invest. So she'll be sharing that with us from her perspective, and she has been very fortunate to see a lot of deal flow in her time as an investor. And Jonah also has a deep tech background, having got a PhD in the world of science. We'll then hear from Chris, who will give us a keynote on the state of funding. And I know this is a topic, if you've been looking at Twitter, if you've been looking at the Financial Review, startupdaily.net, or Smart Company, or any of the other trade publications, there's been a lot of discussion, a lot of so-called newspaper ink spilt on this topic. What is happening? Is the market going up, down, sideways? Use it for early stage companies to get funding. We'll be getting into that. We'll have a panel discussion and, of course, very important, some audience Q&A. My name is Benjamin Chong, and today I'm wearing two hats. My first hat is that of the co-director of the Founder Institute in Australia, and I'll go to that in a moment. My second hat is that as a partner at Right Click Capital, where we make investments into technology companies across Australia, New Zealand and Southeast Asia. Also joining us is Adrian Bunter, who's a well-known corporate advisor. He's an angel investor. He's sat on the boards of a number of ASX-listed companies, and he's also been very active historically in Sydney Angels, which is one of the largest and most active angel groups in the country. Joining us also is Chris Gillings, who is on the venture capital team at 5V. 5V are a firm who make investments across a whole range of businesses and industry types. At 5V, Chris focuses on venture capital. He is all across technology companies in this part of the world. He's also the founder of Cut Through Venture, which is a really cool newsletter that comes out, which provides people who are in this industry with up-to-date information on who's been getting funding, how much they've been getting, and what, more importantly, are the trends around funding quarter on quarter, year on year. So he'll have some fascinating insights to share with us. That's Chris Gillings. And then we have Jonah Ng, who is an early stage investor. I've been very fortunate to have been colleagues with Jonah, and now she is at a well-known firm called Investable. Jonah has a deep tech background, and we are very excited to be hearing from her in a moment. We are hosted today by the Founder Institute, so I thought it would be helpful for me to briefly introduce the Founder Institute before I turn to Adrian. The Founder Institute is a worldwide network of mentors who try to help founders build meaningful and enduring technology companies. In Australia and New Zealand, we have 4 co-directors. There's Phoebe, Paul, Chris and I, and we run 2 programs a year. We've just completed our first program for the first half of this year, and we target founders who are at their idea stage, who are wanting to make significant progress. We're a part-time program, so we are a pre-seed accelerator, and we help founders and their teams get this initial traction and prepare for what we call pre-seed funding. Some of our experts today will hopefully help us get a better understanding of the difference between pre-seed funding, seed funding, Series A funding, and so on. So many people who take part in the Founder Institute are road testing their idea. They're perhaps tossing up between idea A and idea B, and they might be holding down a full-time job. There are a bunch of other, what we would call seed stage accelerators, and they do a wonderful job. However, one of the big differences is that they require you to be full-time working in the business. So you've had to give notice to your employer And these tend to be for teams with a little bit more product, a little bit more traction. So that's where Founder Institute sits. We are the #1 place in the world to help turn ideas into fundable startups and startups into global businesses. We've got over 6,000 alum from around the world who have created over $25 billion worth of value, and we're in over 95 countries. So we're all about trying to help, thanks to mentors and leaders, founders who are doing their next big thing. The founders who are tossing up between whether they go down idea A or idea B, we have what's called the launch track. And we help them pitch, we help them with customer development, we help them develop their leadership skills and emphasize things such as product development and so on. For founders who already have shipped product, who are a little bit more advanced, we have what's called the growth track. And we meet once a week, and over these 14 weeks on the growth track, we help those founders get to that next stage of achievement, next stage of accomplishment. So at the Founder Institute, we like to do a couple of things. We want to find great people. We give them a devoted and global network. We put them through a structured growth process. And we like to provide a lifetime of support. And one of the things that I have noticed in my personal experience, and this has been echoed to me when we've had other people take part in the Founder Institute program, as they do in other programs, is that when you're with motivated people who are doing things that are around their life's passion, they work harder because they're in the company of other hard workers. It's a little bit like when you go for the gym group class. If I go for the group class, I tend to work harder. I do more dips, deeper dips, when I'm doing the body pump than if I were to do it alone. Beyond the Founder Institute core program, we have other accelerators, such as the Founder Lab, that help founders who've completed the core program, which I mentioned before, to get better product market fit. We help founders to get their seed round away with the Funding Lab. Or we'll have a Venture Lab, where these are founders who have already got their seed round away and then want to close their Series A. We have these additional programs that are at no charge, and this is about our lifetime of support. So if you're interested in the Founder Institute, we're running a program that begins on the 1st of August. We'll be holding another event next Tuesday where you get to pitch your idea to other well-established founders, advisors, mentors, investors. So that's going to be a really fun night where we'll be in virtual rooms, you'll get to pitch and you'll get instant feedback. That's super cool. And then the following week, for those of you who are in Sydney, but we'll also be hosting things in other cities, so do put your names in. We'll be hosting some physical meetups because webinars are wonderful, and having a drink and talking to mentors, talking to other founders in person is even better. That takes us to today's event, startup funding in Australia and New Zealand. Are the statistics good, bad, ugly? Let's find out. I'd now like to welcome Adrian Bunter, a friend of mine.
So I think the starting one is, it's good for people to get an idea of where they actually sit in the funding for who you're actually talking to from an investment perspective. And Ben, you talked about pre-seed and seed funding at different stages. And in some respects, a lot of these terms have actually blurred. If you go back years, it used to be sort of just angel investors, and then it became seed, and then it threw in sort of pre-seed, and then you hear people talking about seed plus or seed extensions or Series A or Series A extensions. I think what the important thing is to understand there's lots of different sources of funds, and you need to go to the right people at the right time. So in the earliest stages, most people will get their initial funding coming from founders themselves, from some of their friends and some of their families. So that's that very, very early stage, and those investors are taking the highest risk and therefore normally get the highest return, assuming it's priced appropriately from when they make their investment. You sort of then move in, and family and friends and founders will generally provide anywhere between sort of 50 to a couple of $100,000. Accelerators will do sort of 50 to a couple of $100,000. They move around a little bit. Once you go down, you go a little bit further. You go to angels, and they're sort of as low as 50, but generally closer to 100 to sort of up to $1 million. But most of them sort of sit in the, call it the $200,000 to $500,000 when you talk about those kind of angel rounds. I've also put in there crowdfunding because it's obviously an area that's become a lot more prevalent in recent years. And you'll see crowdfunding go from sort of a low as $100,000, but up to sort of $2, $3, and $4 million as well for the really large and successful ones. And then as you start getting more advanced, you move to VCs who will sometimes come down to $1 million, but generally they're looking to deploy much larger funds of money, sort of 2, 5, 10. A number of VCs will play a little bit earlier, dip their toe in effectively to learn and meet the founder early on, and then sort of progress further. And then as you progress and get bigger, you get to normal sort of larger corporate funds, you get to private equity, public markets, bank debts, and those kinds of things. So I think it's important to understand where you sit for raising money. I think the other key difference for people to understand is people use the word VC or angel investor, and sometimes they mean them interchangeable. And it's important to understand the difference between those two different parties. The angel investor will often invest earlier, sometimes in sort of advanced ideas, and can be pre-revenue. So you might have a product built, but before you've actually generated any material revenues. Angel investors generally, or almost always, have smaller checks, and you'll have a group of angel investors sort of working together to form a round, either together or separately, but you'll have a large number of investors to raise it. That initial fraction is actually much more important than just purely the idea, and it's usually a round of less than $1 million when you're talking to angel investors. Compare that to venture capital, they're investing later. The idea is to put more money into something that's already working, not funding for you to learn whether or not something does work or doesn't work. Much, much larger checks, single or a small number of investors working together. Traction and proof of product market fit is much more critical, and it's unusual for them to be less than $1 million. It's nearly always more than $1 million. A really important thing is angel investors are investing their own personal money, and that what they're aiming to do is make a positive capital return at some time in the foreseeable future. Now, that foreseeable future might be 10 years into the future, but you got to remember, it's their own money, not somebody else's money. Angels generally don't provide just capital. They want to also provide strategic and their operational experience and expertise and their networks to open up and help support the investment. The formal angel investment sector is actually still quite small. It's growing significantly. There's a lot of work being done by syndicates, angel groups that are starting to work together and actually encouraging a much larger pool of people to get involved with angel investing. A really important thing to understand is at the stage that you're raising, position where you are and understand what kind of risks are involved. If you think about general principles of valuation, is the higher the risk, the lower the valuation. So the more you can de-risk something for somebody, the better the outcome and the more attractive you're going to be. So this graph's quite interesting in the sense that if you think about point 1 on this graph, to the bottom left, is really the concept of, you've got purely an idea, but you haven't really built a team around it. But once you bring a team together, you started addressing the talent risk that's involved with a business. Once you've got that talent risk and you've actually built it, you've actually built a product, you've actually sold a product, you've proved that somebody wants to buy it, you've moved from point 2 to point 3, because now you've addressed a market risk, i.e., will somebody actually buy my product? But just because somebody's bought your product doesn't mean you've got a successful business. So you need to get more people to buy your product, and you need to then get to scale. So multiple people buying the product starts addressing the business risk. When you get enough people to buy the product that the business starts making profits, and you've got a sustainable business, you then fully address the business risk and you start moving up the valuation chain. So I think it's important for people when they're looking to raise capital is understand what kind of risks they actually have in their business and where to go and how to address those for people. So you've got to be ready to pitch. So what does that mean? You need to be able to share a plan which demonstrates that you know what you need to do to achieve your aims. And that's your aims at that particular point in your business. So if you're at the very early stages and you've got a product, your initial aims is to sell your product. What you don't need to necessarily have to do is a plan that gets you all the way to the very end where you've got a large, profitable, scalable business, because nobody believes that that's achievable from that very first round of funding. You want to be able to demonstrate you and your team have a capability to execute your plan, right? And if the team is not fully formed, you need to be able to identify the kind of additional resources that you need. And that's part of what your raise will go towards doing. And you also need to be able to tell a very compelling story. As simple as you can make it is best, and is why someone should be investing in your business and why should they invest in it now, today. And then finally, you need to be prepared. You need to know what you need to do in order to raise capital. And that's hard because most people, when they're first starting out, have never raised capital before. And even if they've raised capital once, they've only done it once. They haven't done it multiple times. So it's always different. And investors are different. They like different things. Like you might go and pitch Ben a particular way and he likes it. You might pitch me the exact same thing and I might not like it because we might have different styles about how we think about investing at different stages. So you need to have that. What does it actually mean from getting ready and getting out there, right? I sort of put some big buckets. We're not going to talk through all of these, but just so people have got a bit of a view. So you need to have a strategy. You need to understand your timing, put your stories together, prepare your documents. That might include some financial modeling. You want to have a view on valuation, which is informed by all of that. Where are you going to get the money from and who you're going to target from your investor list and who's your team that is going to actually do the work. Then you've got to get out there. Think about what are the investor questions they're going to ask you? How do you build credibility? What is your actual pitch? How are you going to select investors? I've got in there NDA with a question mark. A big mistake that a lot of founders make when they're first raising is they keep their stuff secret and they want to actually get people to sign NDAs. And the starting investors don't sign NDAs. And when you ask an investor to sign an NDA, it actually shows that someone's poorly prepared and hasn't done any level of research around what it takes to raise capital. People get scared that someone's going to steal their idea. The majority of investors have absolutely no interest in being operators of businesses. They don't want to steal your idea. All they want to do is actually fund you to actually go and build your idea. If you are nervous, you need to be able to have a conversation with somebody to give them just enough information to get to the next stage and actually progress. People will sign NDAs further down the track if there's some secret sauce when they get into due diligence and they decide they sort of want to make an investment. But I think it's important. It's a big mistake that people make. Then you get to the getting the money. So once you've actually done all that, you start getting to a term sheet, you have a negotiation, you will go through due diligence. So actually proving all the stuff that you told people is actually factually correct. And then you've got to do legal documents and issue shares. So there is a long process. A lot of people think, oh, I've pitched to an investor, that's the end of the journey. All my hard work is actually done, but it doesn't actually. You've got still got a lot more to do at that point. What is your pitch deck in pitching? And I'm not going to go through the full pitch deck on everything, but people may have been familiar with what was called the 10-20-30 concept, which is a guy called Guy Kawasaki originally stated this, which said in the simplest form, you should have 10 slides. Your presentation should go for no more than 20 minutes. And ideally you should use text font that is at least 30 points in size. Now, the 30 points in size is not actually a hard and fast rule, but what it's designed to say is you don't want text that are completely slides that are completely full of text that people need to read. It needs to be, they want to be listening to what the story that you're telling them and supplemented around it. So when you're doing your pitching, you need to be confident, you need to know your stuff, but not so confident you come across as arrogant. You do need to be direct and concise. If you're asked a question, answer it directly. Don't waffle on and answer some different kind of question because that's the question you had prepared. Answer the actual question. You want to have an engaging conversation. The best pitches and presentations is where the person's deeply engaged, they're asking questions, it's backwards and forwards, and it's interactive. Support slides are really important. So I said you have 10 slides, but that doesn't mean you can't have a whole lot of other support slides. When somebody asks you a question, you can say, oh, here's the information I've thought about. It shows that you're prepared. It shows that you've thought about the questions you're going to be asked, and then you've got some insights around it. It's really important to practice your presentation, but you don't want to practice it so much that it comes across as a robotic pitch that is so explicitly rehearsed that there's no difference in it. And then bear in mind, as I said earlier, every investor sees the world differently. So you want to try to get a bit of a feel for who that investor is. So you might tailor your pitch slightly to them. Everyone will have seen these slides, but if you need to do a 10-page pitch, this is the kind of stuff you want to cover, right? What's your big picture elevator? What's your problem? What's your opportunity? What's your solution? Talk about your team. This is all over the web. The most important thing about this is you need to personalize this for your business to make it relevant to you so the story flows naturally, right? If you've got less traction and the team is more important, you should elevate the team side of things. If you've got some really fantastic traction points, you want to elevate some of those traction points. When you get out of this, you got to remember that a person's only going to remember 2, 3, or maybe 4 things about what you actually pitch them. So you got to know what you want those things to be that they sort of take away around it. A couple of high-level ones. When you're pitching somebody, if you can take someone through a story and a journey, that actually is really powerful. If there's an emotion, stories and emotive things are actually good. If that person can remember what you've told them and tell somebody else, that's a shareable event in a pitch and actually makes it much, much easier, and they will talk to other people. In a lot of cases, it's important to understand that you're asking, when you're asking an investor, you're saying the business I'm building is going to ask people to do something different. So what is that rationale for change? Why should your customer switch across to your product now? And you don't want to go through just details. It's got to be high level. And ultimately, this story wants to move forward and drive action. You want to get to the next step. Talking a little bit about teams, the team at the early stages is the most critical component of a business. You want to talk about your founders. What are the roles? If you've got good expertise, draw those out. You want to make sure your team is relatively balanced. You're not going to always have everything addressed up front. So be open about where you've got holes or weaknesses and what you're looking for to grow going forward. And then ultimately, you can supplement it with advisors, advisory boards, and board members. Now, if you do that, it's really, really important that they are genuine advisors and you're not just borrowing them for a brand. I once got contacted by a friend who received a pitch, and they said to me, I just met this company. They said you're one of their advisors. And I'm like, what are you talking about? I've had a coffee with these people once. Yes, I gave them some feedback and advice on that, but that does not make me an advisor of that business. So you want to make sure that you're upfront and around it. You don't need to stretch the truth when you're actually pitching investors. Financial forecasts, this is a bit of a subjective one. At the earliest stages, financial forecasts are genuinely, they're generally rubbish. Nobody believes them, right? But some people expect to see them, because what it does let you do is it lets a person understand how you think about your business. And if you've actually got a good grasp of general business drivers and how you're going to make money around it. It also lets you conduct scenario analysis and what ifs, right? You might be going out and saying, I want to raise $600,000. And investors might say, well, we don't think you can raise $600,000. What can you do with $300,000? So you want to be able to give a view about what you can actually deliver and achieve for that different amount. Some people don't like seeing these at all. Because I'm a finance person by background, originally an accountant, I like the numbers. I'm a numbers person. So if you pitch to me, I will drill you on numbers. And the 3-year horizon is more than enough around it. You should go and research the biggest company in your market that you're addressing. Have a look at their financials. There's publicly listed companies all over the place. And you can benchmark how they perform. And if you think you're going to be a more profitable business in terms of percentage-wise than those large companies, you should revisit your forecasts to tone them back a bit. Your most important, when you're having this initial meeting, when you're pitching, the aim is not to get someone to give you a check. The aim is to get the first meeting initially and then get another meeting, right? You need to force yourself to articulate what your opportunity is really simply, so someone can share it, answer the questions quickly, make it as simple as possible. Don't use jargon, especially if you're in an overly technical sector. And most importantly, think like an investor, the kind of questions that they're actually going to be asking you. Now I'll talk a little bit about investors. So what are some of the questions that investors, or as an investor or other investors, ask themselves when they're looking at opportunities? So ask themselves questions like, do I love the team? The team's the most critical person. Do I believe their vision? Do I believe this is the thing they want to focus on? Because it's going to be really damn hard if they're not passionate about it. If they're not, prepared to do the hard yards, they will give up. And a lot of building a business, and Ben and other people in Founders Institute will be able to tell you this is much harder than you think. A lot of people would say, they think it's going to be hard, but it's always harder than what they think it is. An investor's got to ask, is it a great product or service? Will customers buy or use it? They don't. Some investors will say, oh, I wouldn't buy or use it. You've got to make sure that if your customer is not the person you're pitching to, you need to make it really clear who your customer is so they can see what that result is. If you've got traction, emphasize it, because I'm finding out what level of traction you've got. And it can be it doesn't have to be revenue, but it could be people interested in free signups. It could be people using your product. It could be referrals. How big is the market? If it's a massive market, that's a much more attractive proposition to an investor than a small market. The investors are asking themselves, do I understand the market? Because if they don't understand the market, it becomes much harder for them to get across the line. You've got to work harder to get them to make an investment. Investors are also saying, can this business actually make money? Is it sustainable? Can they become a profitable business? Some people are then saying is, do I want to lead the investment? If I'm not willing, is there someone else willing to co-lead it? They're asking, how much should I be investing in it? Because it's a diversification play. What's the valuation? How much equity? What are the other comparable? What are the other companies out there? And then will I actually be able to sell my investment at some particular point in time? A useful thing for startups is a valuation method called the Berthus method, and it breaks it down into sort of 5 really broad key risk areas. And it talks about, what is the idea? Do you have a prototype? Is there a management team? What strategic relationships do you have? And what product will roll out in sales? And what it effectively says is each one of these buckets is worth $500,000 of valuation. So if you are really strong on your idea and your proposition, that's worth $500,000. If you've built a prototype and you can show that it's working, that's worth $500,000, because each time you tick off one of these boxes, you address a risk concern of an investor. Now, this is quite simplistic, and there's always variations why you look at this and say, oh, the valuation you can get is $2.5 million. Now, you do adjust this for industry and size and area, and is also designed for pre-product or very, very early revenue businesses. So if you're established, got lots of revenues, the Berthus method is less relevant to you, but it's a useful way of thinking about, how do I score my business and how do I address these things to make my business more attractive for an investor. Now, a couple of other things. People, when they're raising capital and they think about competitors, they're only thinking about product competitors. But when you're raising capital, every other startup out there is a competitor of yours. They're also trying to raise capital, because an investor has got plenty of opportunities to invest in your business or somebody else's business. Now, people also say information is power. Now, unfortunately, when it comes to raising capital, investors have all the information because they receive pitches all the time. I see across various sources about 2,000 deals a year across Australia and internationally, right? So I will quite often see multiple pitches for the same thing. In the Australian market, I get told by people that there's nobody else working on this particular thing at all, yet I've seen 3 pitches for exactly the same thing, and none of those 3 companies know about the other companies around it, right? Because everyone's building things quickly. Raising capital is very, very hard. It's hard everywhere. You should assume it takes 4 to 5 to 6 months to raise it, so be prepared. Don't go to raise capital. If you need the money next month, you should assume you're not going to get it. You need to find other ways to get through. Final comment on this slide is, take advice from other startups with care. Most startups who give you advice on raising capital have only ever raised capital once before, or twice before. And their advice is normally couched in what worked for them, and what worked for them doesn't necessarily work for other people. So I think people should take advice from multiple people, and don't assume when an investor is giving you advice that they're giving you advice just to get the price down to get a deal. Most cases, most investors are giving you advice because they actually want you to succeed and trying to help you out. and they're just telling you what's actually happening in the market at that point. That's it from my perspective. So I'm sure there'll be plenty of opportunity for Q&A and panel discussions. I'm looking forward to hearing from others.
Adrian, that was fantastic. Thank you for sharing some of those tips from many years as an investor as well as advising startups. Thank you very much. We're now going to turn to a little panel, and I'd like to invite Joe to come on down to introduce yourself and to tell us a little bit about the different types of investors from your perspective. And when people talk about an investor's thesis, what's in the thesis? What does all this mean? Is that something that you write at university and submit to get marks on? If you could help us by illuminating some of these funny words that are used by investors.
I'm sure you're just mentioning thesis because of the thesis that I had previously written part of my uni days. But an investor thesis is a little bit different. I can start off with Investable's thesis, and then we can kind of maybe move on to general thesis. At Investable, we're at early stage VC, and we say that we're at the seed stage. So I think in terms of stage, that's the first thesis I would say. I think different investors, as Adrian has mentioned, invest in various stages, whether that's at the angel stage or pre-seed to pre-series A, which is Investable's. Or in my right click days, I think it was more on the pre-seed to pre-series B stage. And then you have other investors that are mostly on the maybe just focusing on series A and beyond. Then you have private equity after that. Yeah, so that's the first one, stage. And second one could be sector, for example. So maybe, some investors only like to look at climate tech. Investable has a climate tech fund. So that one's purely for anything that will help go towards net zero or net positive. I work on the general fund, so that's literally any sector minus biotherapeutics because of the various FDA regulations and things like that. And then you do have other investors who only look at some of the med ones will only look at biotherapeutics. So again, different investors have different mandates when it comes to sectors. Geography could be another thesis. Do they invest in Australia, New Zealand only, Southeast Asia and Australia? I think you'll find that most VCs in Australia those that are based in Australia will be predominantly investing within the Australian ecosystem, but they might have ties to other countries around the world. Investable has ties to Southeast Asia. Some other ones have ties to Israel, the US, the UK, etc. So those are three main ones.
When you see a deal that comes through your desk or your filing system, could you walk us through how you assess a deal? So assuming that perhaps it's within your thesis, could you give us a bit of your heuristic so we could get through to you?
Sure, happy to. So we see a lot of deals every month. I think with and if you ask any investor, I think over a course of a year they'll probably see a couple thousand or many thousands of companies. So how do you, I guess, go and look at these thousands of companies and then take them through, I guess, the investment journey to actually making a decision, right? So for us, we like to know the founders early. Some of them aren't even maybe ready for investment yet, but I think it is, and as Adrian mentioned, the first one is to do with the people, and that's the first risk. So first of all, understanding the founder, their vision, why they're doing this business, and then the second bit in that is then understanding certain other things about the business, and then getting conviction in that. The journey for us is we do all of that in the space of 6 weeks. It's relatively quick. How much can you learn about a person in 6 weeks? There's a lot of back and forth conversations. Some of it about the people, some of it about the wider team, about various aspects like the business model, your traction to date, all of those other things. It's a big question. Happy to break it down further as well.
Right. So is what you're saying, Joan, we are going to have Q&A later, is what you're saying at Investable, you're happy to build relationships with founders who are in your field of interest before they are officially fundraising?
I think it's officially ready to fundraise. So say, for example, they've already, they've recently done an angel investment, but they're not ready to do a VC investment yet.
Okay.
That's a good spot. We have talked to a few founders, maybe researchers, for example, that are thinking about spinning out. I think that's probably the most common case where it's not yet a business, but it could be a business. I think that's more niche in that there is actually some tech IP there that could have a commercial application.
Okay. So the team is very important for you. Thank you very much, Joe. I'd now like to bring in Chris Gillings from 5V. Chris, if there's anything you'd like to say about yourself that I haven't already mentioned, please share with us. And love to get your perspective on what you've heard so far and tell us about 5V's thesis and your investment focus, because you run a number of funds. And I think it was interesting that Joe made the comment that Investable has a climate tech fund. So obviously, if you're wanting to do something around carbon fuels, probably not the best fund for you to approach. And similarly, if you've got a software company, it's probably not that fund to approach, but you could approach Investable in their general fund if you had a software type business. But really keen to get a little bit of your background and your perspective on this, Chris.
Yeah, absolutely. And thanks for having me, Ben. So first of all, great to be here, everyone. My name's Chris Gillings. As Ben mentioned, I'm sitting in the offices of 5V Capital. We're a venture capital firm that's actually part of a private equity firm based in Sydney. So 5V has been around for almost a decade, but most people sort of in finance and business circles know us for our private equity offerings. So we're on our fourth private equity fund with almost $2 billion under management. I'm part of the VC team, much smaller part of the company. There are four of us investing out of our second fund. We are, I think, far more narrow than Investable, and both in terms of where we invest and what stage. So we invest basically purely in B2B software. We have a broad definition of what B2B software is, but if you think of it being, without wanting to state the obvious, businesses that are building software at the core products and that are selling into businesses, whether that's enterprise, small business, government, non-profit. So basically not selling to the consumer. We are a high conviction fund, so we will typically lead at the Series A or B, coming in with a check size of somewhere between $3 and $10 million. And we will look to follow on the portfolio, which will typically only have in any given portfolio 10 to 15 or so companies. So we do take a different approach from Investable. We work very closely with the folks at Investable and RightClick and other early stage funds. But because we invest at that later stage, we're typically coming in 9 times out of 10 when the business has already had some investment rounds previously, and more often than not that has been had a VC fund involved in some capacity.
Yeah,
absolutely.
We have co-invested. So,
absolutely.
Yeah, okay, no, that's very helpful.
Yeah, and look, everything that Adrian went through in that presentation was dead on. And look, even a number of the comments that Joanna made around the process and how we think about investments are very similar to Investable. I think the biggest change for us, I think, is partly because of our private equity heritage, in that our investment committee is actually the same investment committee as the private equity firm, and we are all, our team are more finance background than technology background. We probably go deeper on diligence and spend a lot more time and move a bit slower than some of our peers. And so in any given year, we'll make a good year for us would be 5 investments. But again, as I mentioned, they're quite large investments. And so we'll spend more than a month diligencing a company. And so this slower environment actually works to our advantage.
Thank you. Thank you very much, Chris. So what guidance do you have then? Because what I've heard Adrian say, what I've heard Joe and you say is that different investors will have different preferences. And therefore, if you're a founder who is wanting to go and approach investors, it's good to approach the investors who are more likely to invest in you. If I've got a climate related, or if I'm a B2B SaaS business of a scale which could absorb the $3 to $10 million worth of capital, do you have any guidance on how a founder could categorize or work out which are going to be the more choicey targets than the less ones?
Yeah, I think the good news is that there are now, it's a very deep market of investors in the Australian market. Even 5 years ago, there weren't a lot of sort of funds of scale that were investing with large checks, and the angel market was still in its sort of early, the angel ecosystem, I should say, was still in its sort of pretty early stages. I think Adrian mentioned the angel market in particular has evolved a lot very quickly over the last couple of years. I actually run an angel syndicate, which is free for people to join, that is called Cut Through Angels. So you can sign up for that if you're a wholesale investor. But the good news is there's a lot of options. I think what you're alluding to, Ben, is that not every investor is appropriate for every startup, and not every startup is appropriate for every investor. The other good piece of news is that there's a lot of information publicly available. The most obvious space is on the investor's website. I think if you went to Investable's website, or if you went to 5V's website, it would be very clear that we invest at different stages, and we're looking for different things in the stage of the company that we invest in. And so I think, Ben, to your point, doing the homework up front in terms of understanding who might be the right fit for your company is worthwhile, in that it'll mean that you don't waste time, following up with investors that are clearly just not a fit for you and your stage. So yeah, the short answer is do your research up front, and I can say that there's certainly enough investors out there now that are covering a pretty broad spectrum of sectors and stages that there's plenty to choose from.
Okay, I think that's sage advice. Thank you very much, Chris. Given that we've got the spotlight on you, why don't we have you share a little bit more about the state of funding in our part of the world? Clearly, there have been a lot of news stories in recent time about some venture-backed companies perhaps calling it a day. We've heard some companies perhaps taking down rounds. And there's also been news from one of your publications how some of the numbers or the value of some of these financing have changed. So really keen to get your perspective. Look at this.
Yeah.
Capacity, July 23.
Boom. Hot off the press. So tomorrow morning, we'll actually be sending this out and going live across various places with our quarterly report. So as Ben mentioned, I started a business a couple of years ago called Cut Through Venture, which started as a newsletter, which basically all it did was write about funding in the Australian market, with this very specific focus around the data. So trying to drill into the size of investment rounds, what type of industries was attracting the most investment, and what states, what investors were most active, etc. We've sort of evolved that business over time. As I mentioned, we've launched the Angel Syndicate, but we've also stopped the newsletter. So we don't do a quarterly newsletter anymore, but we now do we don't do a monthly newsletter anymore, but we now do the quarterly report. And this is coming out tomorrow. So you're seeing it before it's out. So I'll trust that you don't screenshot it and share it everywhere. But basically, 2021 and 2022 were the beginning of 2022 were pretty wild times in Australian venture capital. There were months where more than $1 billion of deals were being announced. In totality, there were more than $10 billion of deals announced, which was 3x the size of the prior largest year. As has been the case globally, the venture market here has slowed down a lot in the second half of 2022 and into 2023. And so you can see here in Q2 of 2023 in the middle there, this is for the entire quarter as opposed to the month. So there are $810 million of funding announced across 90 deals. So you can see here on the right, the big jump up in 2021, the yellow bar being total capital and the squiggly line, red line being total deals. And so you can see there was a big hill sort of during the COVID era where everyone was rapidly deploying capital, and there were all of these international investors entering the Australian market and looking to spend up big. And that's really fallen off in 2022, sort of trailing global listed equities markets. And then as interest rates have started to rise, that sort of added further fuel to that sort of compressed market. So this is literally the report that's released tomorrow. So I'm going to flick through certain things, but I guess you can see here where we're tracking relative to prior years. So we are tracking below, this as we finished the first half of the year, we're actually behind where funding was at the midway point of 2020. And there's some interest, there's some sort of nuance to that, but at a headline, the market has certainly slowed down a lot. And, at a headline level, at least, there are far fewer deals getting done, and they're happening at smaller sizes as well. As part of our report, we actually survey professional investors. So investors at VC funds, family offices, potentially there are certainly some large angels. So I'm not sure if Adrian gets the survey, but we'd love him to respond. But we basically try and get a sense check of what the vibe is on the street amongst the investors. And I won't go through these one by one, but I think a couple of interesting call outs here is in the top left, you can see, with all talk recently about potential recession that might be around the corner, will that affect your investment pace? And you can see that the majority of investors at least say that it won't. And a small portion will actually say that it'll cause them to increase the pace of their investment. In the bottom of the, left, and then in the middle there, you can see that the relative to last quarter, VCs are reporting and investors are reporting that deal flow has actually slowed down even further. So we've not seen sort of a turnaround in the amount of deals coming across investors' desks. However, if you look in the middle, investors are still very confident that they'll end up doing more deals in the second half of this year than they did in the second half of last year. So it's a bit of a funny time where deal flow is down, but people seem quite positive about the direction of the market, and potentially we've hit the bottom of activity. In terms of the portfolio, so we ask questions about the investor's portfolio. I think as Ben mentioned, there's a lot of, I would say probably in Australia, over indexes on negative press in some of the larger publications about, getting excited about companies having to let go their employees or shut down, which is kind of unfortunate. But, it does get the clicks, but you can see here that a very small portion of investors have reported that their portfolio companies have had to shut down. And remember that this is a sector where we expect our portfolio companies or a portion of them to shut down. And you can see in the top left-hand corner, there is 49% of investors say that the overall health of their portfolio is in good shape or better. In terms of getting into some of the deal data, you can see here, so deal sizes are dramatically down, but you can see the volume of the number of deals that get done in the different size brackets. It's sort of across the board is lower. So it's people will talk about, and it certainly is the case, that large deals are really not getting done, but it really is across the board that we've seen a compression in the market, and the number of deals that are closing has certainly slowed. It's not a good slide to show during a presentation, but basically what this is showing is that the average deal sizes and the median deal sizes have come down significantly, except in the angel/pre-seed stage. So you can see that top set of bars in the light green. You can see the very top bar is the average and the median deal size in Q2 of 23. You can see it's way higher than historical. Part of the reason for that is because there are fewer larger deals going on, and so investors who would have usually been investing later stage are going earlier. And because a lot of professional investors or VCs are entering that earlier stage, that is naturally just lifting the amount of capital that's flowing in. And so for first-time founders or founders that are raising that pre-seed round, in many respects, it couldn't be a better time to be raising. I think investors are certainly being more discerning and not investing in as many companies, but for good opportunities, they're willing to invest even more than what they have historically, which is an interesting dynamic. So valuations are very hard to come across valuation data. Essentially, the only people that know about the valuation are the people that participated in the deal. No one really has a lot of interest in making that public knowledge unless the startup is in that sort of unicorn territory and it's become a sexy news story. So what we do is we ask, as part of our survey, investors where they estimate valuations have moved from the peak. And so you can see as the stages get later, the valuations have fallen more. So deals at the Series C and beyond have really come off, whilst at the seed stage come off less. We haven't included the pre-seed in our valuation sort of survey because, as Adrian mentioned in his presentation, there's like a lot of art to how to value a pre-seed company. There's not a ton of information to go off, and so there's generally, and Adrian may have a different viewpoint, but in terms of like the range or the band at which pre-seed deals get done, it kind of stayed relatively steady. There are a couple of outliers every now and then, but it hasn't moved as much just because we are talking about smaller dollar amounts. So we didn't ask a question about pre-seed, but the bottom line is valuations have come off dramatically, just as they did in public market tech. But as at the later stages, it's certainly been more heavily impacted. It's an interesting one. So you can see here, if you don't know how good the quality is, but hopefully you can read here. So you can see on the left, it's a survey that we did in Q4 of last year. And then on the right, it's a survey from the most recent quarter, and you can see the popularity of different segments. And so you can see here that at the very top for the last 2 quarters, probably unsurprisingly for anyone that's been reading the news, AI and big data is right up the top. ever since ChatGPT took the world by storm, investors have really leaned into that sector. So this is popularity. So this is the sectors that people are most excited about as opposed to where they've actually invested. So AI right at the top, enterprise software right at the top. Enterprise software always sort of, it's a very broad category, but it's, you know, in an environment like we're in at the moment, very appealing to investors because it is a, you know, pure software solution, globally scalable, relatively, you know, you're not spending a lot on factories or production. So a popular segment in an environment like we're in, and then you can see even the other like cybersecurity, I would say the same thing, ed tech and the other top ones. Some of the big fallers, probably unsurprisingly, blockchain, which sort of had already started falling by Q4, but now is like right cemented down the bottom in terms of where investors are excited about. Health tech had a bit of a plunge, as did biotech, but you'll see in the data that investors are still plowing plenty of cash into those spaces. So this is an interesting piece, and you'll have an opportunity hopefully to read the report in more detail tomorrow. But if you compare what investors are most excited about, it doesn't always tie up to where the money's flowing. It's more of a leading indicator. Skip through that. Yeah, so big deal, large deals, which we define as sort of deals over $20 million or $50 million are way, way down, and they haven't shown any turnaround. That is a global phenomena. So even in the US, there's very few very large deals. A lot of the international funds that were participating in the Australian deals have sort of fled. Nothing against Australia. It's more so they're just looking after their issues in their own portfolio and their own country. And so it certainly has slowed down at that later stage. And as a result, the large deals are just harder to get done. I'll let you go through some of these companies on your own tomorrow. One of the things we do talk about in cut-through reports is female founder funding, which if any of you are in the space would be aware, females don't receive as much funding as their proportionate representation in the population. And so we don't claim to have a solution for that necessarily, but we do like to shine a spotlight on it. I will say that funding this year is actually, as a proportion, has been quite good. Sort of running at last month was like at a sort of towards an all-time high. And if you look at participation in deals, so if you don't look at how much funding, but what percentage of deals that got done had a female founder involved, you'll see here that angel invest at the pre-seed, Series B and seed, it's all tracking at the all-time high, albeit on a smaller denominator. So I'll leave it at that. You got us on a funny day, and the report comes out tomorrow. So encourage you to sign up at cutthroughventure.com and you'll get that in your inbox tomorrow morning.
Chris, thank you so much for giving us a look at the sneak peek of the report. I think that's very interesting and wonderful to see what you might hear anecdotally backed up with numbers. So thank you very much for putting that on. We now come to a panel time, and I'll re-invite Adrian and Joe back. And Adrian, Joe, some immediate knee-jerk after Chris shared some of that data with us?
Joe, do you want to go first?
Yeah, happy to. Yeah, I think it all makes a lot of sense. Definitely some of the similar trends to what we're seeing. And I think you're absolutely spot on in terms of like pre-seed and seed not being as affected, and then having a much more of an impact on the later stage rounds is what we've seen. Again, spot on with the, I guess, slower deal flow as well. Have seen some of that too. So yeah, no, agree with what you said.
Yeah, I agree with that. I mean, I actually love the Cut Through Venture reports that Chris and the team put together. They're really good work. Really good and useful insights, I think, for people. I'm always fascinated by some of the intention stuff, because I think when people respond to intention stuff, it doesn't always play out to what happens in reality. And I think a lot of people sort of say, yeah, I plan to do more, but they don't. I think the hurdle rate for an investment has definitely increased substantially for a lot of people. I had an investor the other day who's an angel investor who does a fair amount of stuff, but also does a lot of funds, etc. And his comment to me was, I can effectively get risk-free returned cash in the bank at sort of 4 to 5%. I can get private credit type investments that's not high risk at sort of 10 to 12%. I can do venture debt investing at sort of 20%. So my hurdle rate for sort of angel and other kind of stuff is now up the level, because all these other ones are actually relatively high return and lower risk. So I think that, again, that's the competition piece that I talked about earlier, right? You're competing with all the investment opportunities that people are doing. I think the other one that's quite interesting in that, and I look at the data, is single big deals skew the data a lot. I think you saw that with some of the mega rounds on that before. I do wonder whether or not that Constantinople 32 mil seed round skewed the seed numbers up. I suspect it probably did. The one I did find interesting on that stat was just the what seemed to be significant reduction on interest in clean tech over the last 2 quarters. So it's sort of like, I think it was, I can't remember if it was 1 or 2 in on the left hand side one, and then it sort of dropped, down about 10 positions or so across the 2 most recent quarters. Given all the talk and discussion about it, I was surprised at
that's right. Maybe people are more concerned about ID and privacy, because that went up.
Yeah, and looking at, and I think, and in fact, one of the most recent ones I've invested in is a cyber one too. So I think there's always going to be increasing interest in cyber. There's also a lot of deals that happen that don't get announced because the company's waiting for the right time to announce them when it's most opportune for them. Because quite often they're raising some capital to do some certain things. If you're going to get publicity and attraction, you want to make sure you've got the best foot forward to actually sell it. So there's this sort of lagging effect on some of those things as well. But yeah, I think I love it. It's awesome. Good work, Chris.
Yeah, I'll just make a couple of things. So the last point is absolutely correct. There's a lagging effect in the deals, and so I think a lot of, almost universally, the deals that got announced this month were not done this month, which was another part of the rationale towards moving to a quarterly cadence on the reporting as opposed to a monthly. I think the slide and Adrian made a very good mathematical point around how outliers can really pull averages out. And so that very sort of confusing slide that I said was not appropriate for a presentation, dig into that one. So that shows the median and the average, and what you'll see. So medians are not as unaffected by outliers in that, they're the middle. So you'll see that the average actually swings around like a crazy thing. But the median is a little bit more consistent. And that's just, we sort of learned that as we got hate mail over time, and introduced the median accordingly. But yeah, appreciate both Joanna and Adrian's comments.
Chris, you can't please all the people all the time.
No.
But on your comment on the valuations, I reckon, and I think the valuation expectations, I think that's a good way of doing it. I reckon the pre-seed stuff's probably also come off sort of that 30% to 40%. So I think deals that were being done at, if you pick us on a normal kind of range, I call it sort of 3 to 5, is probably now in the 2 to 4 range.
Yeah.
So, if it was a 3 to 4, and even 5s at pre-seed would probably sort of outliers in some respects. Like the vast majority of deals have been done in that sort of 3 to 4 mil range. I think now they're sitting in 2.5 to 3.5, 2 to 3 mil range for that pre-seed first round.
That would make sense. Look, thank you very much for those observations and those knee-jerk reactions. Really appreciate that. We're now going to turn to some Q&A, and I can see some Q&A that's appeared in my Q&A window, so I will ask the questions. But reminder to anyone, if you've got questions of these experts, it's very rare for you to get 3 investor experts in the room. They're happy to answer any question. So Attendee wrote something a little earlier. What any percentage of investment to local v overseas startups? I think, and they followed up, meaning, will overseas startups get a lower chance of funding in Australia?
A lot of, so I'll just speak for VCs for now. And a lot of VCs in Australia are in early stage are ESB CLP compliant, which is a structure that has tax breaks for the investors in their fund. And as part of that, adhering to that structure, it means that 80% of the investments in the fund go towards Australian investments, and then 20% can go to companies that are domiciled outside of Australia. So if you're a company in Australia, but you are domiciled outside of Australia, you'd fall into that 20% bucket. There are also other reasons why you might fall into a 20% bucket. For example, if you more than 50% of your staff are situated outside of Australia. But there are various things like that that probably could reduce your chances. And I'll pause there, and if anyone else has anything else that I'd like to add.
You don't see many super early stage investments receive investment from a different market to where they're actually based. It's quite unusual. I mean, in the very early, if you go back to the original angel investing, you actually only invested in something you could drive to within about an hour and a half, which is why Angel Group sort of formed around effectively cities. That's obviously changed a bit. What you'll find at the biggest end of the scale, the best and biggest companies will actually draw investment from all over the place, because those big funds are looking for the absolute best investment that they can get. So I think that's probably more the driver of it.
Quick question here from Humphrey. What's better for a startup? And maybe, Humphrey, if you can provide a little bit of context as to stage, but he says getting an investor, presumably it means a single investor, or going down the crowdfunding path?
Because I think it's not necessarily an either or question. I think you've got to pick the right kind of investor for the stage the business is at. And some people think, I can't find an investor, so I'll just go do crowdfunding. But crowdfunding normally has to have some anchor or some promotion that comes behind it as well. Crowdfunding can work really, really well for a consumer branded type business that's got an existing customer base that people can actually get behind it. But if you're at the very early stages, you're just as unknown in the crowdfunding space as you are in the private one. So I would actually say that super early ones, get some investors first, get some traction, build some customer base before you really think about crowdfunding. Crowdfunding space is very competitive. The crowdfunding platforms, and I've been involved in raises across a number of them for both clients of mine as well as portfolio companies and boards I sit on. So they're quite selective on what they take on as well.
Okay, thank you very much. I'll just do one more angel-related question for you, Adrian, and then we'll move on to one. Is it critical for companies to certify themselves, either with their accountant's help or self-certified, as an ESIC, which is an early stage innovation company?
Look, it's useful because it's a question that gets asked, right? So an ESIC is quite attractive for investors if you can get it right. It means they get a 20% rebate against their tax on the investment they make, but more importantly, it means that any gains they make over the 10-year period is tax-free, which obviously supercharges your returns. So yes, you should get a self-certification, because actually you're the only one in the early stages who can actually really answer the questions for it. And there's a simple checklist on the tax office's website that you can actually use to verify it. But it's not the be all and end all. I've never seen, well, actually, sorry, I can't say never, because I have seen somebody do it because it was an ESIC investment. I thought it was a terrible investment, but they did it anyway because of the tax benefits. But the whole point about angel investing is you want to make money. Like, you want to make money, you need to get a gain. If you happen to get the extra tax benefits on top of it, that's the cherry on the top. It shouldn't actually necessarily drive it. But if you're an early stage startup, be wary of just the criteria, because the last thing you want to do is work out that you lose your ESIC benefit on 30 June because you've either spent too much money or earned too much income. And as a result of that, you leave it too late to actually raise money and can't raise the capital. So as you're coming towards the end of when you finish certifying, make sure you're aware of that and actually get in and do the raise, because it can be a massive incentive for investors.
Thank you, Adrian. A question: is there a drawback to being a solo founder? Someone's a bit fearful about approaching investors as a solo founder. Who'd like to take this one?
I mean, not. I think that the data would probably say that having a co-founder has historically helped, just from a building the business perspective. It's very rare that they do exist, but it's very rare that an entrepreneur will have every skill in their arsenal themselves to build a business from scratch. But from an investor standpoint, if we stumbled across someone, and particularly once you're at the stage where 5V or a later stage investor would be looking at you, where you've already somehow got to that stage and you've got to the scale where you can employ really talented folks to complement your own skill sets, then we wouldn't care. I don't even think that we don't put it in our little database whether or not it's a solo founder or how many founders. But I do think that building a startup is really hard, and having someone that you can work with and trust and can be incredibly, or will almost definitely be very valuable. And if you're not if you have ambitions of building a technical product and you're not a technical person, it's going to be very expensive for you to try and bring in a technical person that you can trust and that will do a great job. And so I think that the most important thing is that the founders, or the founders plus the first few employees, have the skills required to execute. That would be my view.
Thank you for that, Chris. I'll take this question from Ash. Are there foreign funds, foreign VCs in Australia, particularly in Queensland? I suspect in Queensland, first of all, there aren't that many foreign VCs in Australia. Some of them packed up their offices recently, and there might be one or two in Queensland, but I wouldn't expect there's a lot. How about this one? How do investors... Sorry?
I mean, physically, maybe not, but there's certainly, as startups get more advanced and larger and start to get the attention of overseas investors, these large funds are very well resourced and have folks all over the world that are scouting for them. So if you're a business, if you're killing it and growing super fast and getting really big, then it'll shock you where the investors will pop up from, no matter where you are, whether it's Queensland or Northern Territory.
Exactly. Okay, how about this one? How do investors perceive a geographically distributed team of founders who might not all be based in Australia? I think this is a really good question.
I think in today's world, it makes no difference. Like, the reality is do the team complement each other? Do they have a good working environment around it? I think one of the things that potentially becomes harder in this is actually culture, and how they're going to go about building the culture of their business. But I think the last sort of 3 years has made people accepting of investing almost anywhere, really, in almost any kind of structure from teams and how they work.
Adam, I can see your question here. If you're able to provide a little bit more detail on what type of an app, is it a consumer app or a B2B app, then I think we can get a better answer from our panel. Let's move down to an anonymous attendee. How much minimum equity should the founders and key employees have to raise investments in future? I think maybe they're asking, if you are raising money from investors, how much dilution is acceptable?
Ideally, for us, being at the seed stage to, pre-series A at the later stage, for us, we want to see founders with, close to 50%, as in the team of the founders, and ESOP, hopefully a bit more than that, before you kind of get onto that next, higher dilution, series A, B kind of rounds. Obviously, you'd want as much as possible. Assuming that you start with 100%, you have angel investment, they come in, they take like, a few percent here and there. Then you've got your, pre-seed or your seed investors, and they take 20% off the table. You've carved some out for ESOP. You've got into maybe seed extension or, a Series A, kind of Series A extension. It can get diluted really quickly. So I think after we're done with it, we'd like to see, kind of 50% there.
By the time Investable's done with it and it gets to us, 50% is a good sort of rule of thumb. I think the reality is, look, we are finishing off an investment now. I think we're coming in at 18% of the cap table after one round. That's probably at the toppy end, but like you're looking at your Series A coming in at, let's call it 15%. You're going to have to carve, if you are doing really well and you want to attract talent, then you're going to have to carve out some a pool of options to attract really good talent. And so the way that I think about it is that we want our founders to be highly motivated financially to stay working on this endeavor, because if you're a talented business person or a technologist, there are a lot of easier ways to get rich. Maybe not mega founder, outcome rich, but you can make $500,000 not doing too much at Google. I'm sorry to the Googlers online, but some of you do a lot. I'm not talking about you.
Well, you should be saying sorry to people who are not at Google.
Yeah, but like so we've had we've come across cap tables that we've seen in pitch decks over the last few months where the founders, by the time they get to us, are collectively, there might be 3 founders that combined own less than 20%. And for us, it's a complete non-starter. We can't do it because, if they own collectively 20% of a business that's worth $30 million, they'd be better off putting pens down and getting one of those good jobs at Google.
I mean, I think what you said there, I mean, there's a couple of nuances on this. So generally, if you look at a raise, is people should dilute, ideally no more than 20% dilution in any particular round. And ultimately, as you get bigger, the dilution should actually reduce and get less. And when you start getting to the much larger rounds, the dilution comes down a lot. I think the other thing is it also depends on how many founders you've got. So if you think about a founding team of 4, and if they all started equal, they actually individually, after you get a few rounds down, them individually have got quite a significant dilution, and that can lose motivation. That's completely different to a solo founder who still owns all of the founder equity at that particular point in time. I've seen a handful of deals fail to get funded because the cap table is broken, because there's not enough in there. There are some creative ways that you can go about to fix that up by recapitalizing and re-incentivizing founders. And investors need to be aware of that early on. I've seen a couple of deals where early on I've said to people, no, you actually need to fix this now, because if you don't fix this now, you won't get to the next stage and things will go wrong a little bit. And you can also, and I've seen that quite a few VCs and parties, especially slightly later, is actually do some creative incentive structures where they've given bonus shares to founders based on performance. So they have a hurdle rate around it, so you can sort of top them up, and everyone's actually happy for the founder to get them, because if they do, it means the founder's really performed and the money's up there. So you can fix those things up, but it's definitely something to be wary of. And there's quite a few tax tricks when you get to that stuff as well.
Okay,
advice.
Indeed, we're going to the home stretch. So I've got a couple of quick fire questions. So this is from Sandeep. At what stage of the startup's life should they begin looking for investment? There was some advice about the time frame to get investment. Some people develop prototypes with their own funds, and associated with that question is, will it affect, how much does it affect getting investors if a majority of team developers are outsourced?
I'll give the 1-sentence answer, and then I'll let the other investors give a more detailed response. And like, wait as long as you can to raise. like to Adrian, I think Adrian made the comment, the longer you wait, the lesser your company need to give away. VC, angel, all this stuff that the three of us do, four of us do, it's very expensive capital. You're giving away potentially like tens and tens of hundreds of millions of dollars of future value. So, like unselfishly, I would strongly recommend to wait as long as possible before you need to raise. Would be sort of my counter surprising response.
Mm.
The caveat I would put to that, Chris, though, is that there are some times that if speed is of the essence on execution for some things, sometimes that extra dilution is worthwhile doing. So
Sure.
I would definitely recommend people sort of work out saying, what could I do by myself and what would it look like? And if I had capital, what would it actually look like? And at the end of all of it, am I better off as a result of doing it? If you've actually got revenues, you should start exploring some other funding mechanisms. So some of the revenue-based loans, venture debt, and some of those kind of things. Now, introducing debt into a startup substantially increases the risk, but for the right kind of startup, it can be very beneficial for it. So it's definitely worth exploring. That there's about 4 or 5 revenue-based lenders in Australia now. They will start relatively small. They're really good if you've got your marketing down pat and you want to just put more money into marketing and you know you can get a return on it. They're actually exceptional for those kind of businesses.
Great. There's a really interesting question here from Matt. What do you typically like to see founders spend your investment dollars on? Conversely, what are the red flags you've seen in spending plans? Joe, what are the red flags when people give you a doc? What do you like them spending money on?
Things that depreciate, like gold taps for sparkling water, for example, is not a great way to spend your money. However, hires and getting exceptional hires is probably something that might go down well. That's the short answer. It could be anything far and few in between. But there's a lot of reasons why founders raise capital, and you'll see it for product development. Maybe there's infrastructure costs. Maybe they need to kind of prove out their sales strategy, bring on a few extra people on the team to help with various aspects like that.
Spend your money on growth. Red flags, high founder salaries.
Yes, that's right. Yes, a little bit like the gold taps. So I'll come back to Adam. Thank you for putting a bit of detail. Adam's interested in building a consumer app. And one of his hurdles is how many customers will pay for this consumer app. And of course, so many consumer apps have developed a bad reputation for making income. How often do you get pitched consumer apps, and what would it take to have a consumer app be pitched to you and make it to the second meeting? Because as Adrian's saying, the goal is to get the next meeting.
Personally, I think this is, look, it depends on what it actually is, right? Like consumer stuff can be difficult. But for example, I invested in the first round of Simply Wall Street, right? Which was a consumer app, pre-revenue. It was gated in terms of some thresholds around it, but there was a strong belief because of the nature of the product that people would actually pay for it, which proved massively correct. But there's lots of, like, consumer apps are hard. Like if you're selling stuff in the app store, like you've got to have big volumes, big things to actually work, and proven teams. If you've got the model that works though, it goes fantastically well.
Are there investors who are willing, or are there investors out there who invest to be paid back with cash as opposed to equity?
Lenders.
Lenders. I think it must be debt. Yes, I'd say, refer to Adrian's response about some of the revenue-based lenders.
Yeah.
There are a couple of other ones. I've seen a couple of deals done and they're very nuanced businesses. So if you've got a business that's really a timing difference from working capital, so you need some money to get started, but you're going to throw off large amounts of cash, and customers effectively become your working capital, so prepayment type stuff. I've seen a few people do that, fund it for a short period of time. They do get some extra warrants and options in it, but it's a lot less dilutive if you can get it to work. But it's pretty rare.
Yeah. Okay. I'm very conscious of the time, and there are a couple of questions around how do you find investors for either a physical product or for a health tech product or for a blockchain product or for someone who's based in Queensland or in EdTech, do you have any suggestions on if I'm new to investor land, how could I go around finding investors in physical product at my stage, or an EdTech, or a consumer app? How could I find investors that are more suitable to me instead of the machine gun approach?
So I just dropped into the chat a little very janky website that we spun up at the end of last year, but it is up to date with VC funds that invest, are currently active and currently well capitalized and doing deals. There's a very basic search functionality, which is you can choose your stage and the sector. So certainly can choose health tech, you can choose blockchain, and how much you can search the stage you're at, etc. And you'll see there, I think we've got more than 100 investors on the site, and we make them pledge that they're still active every now and then. We can't verify it, but we see it in the data, and the majority of them we can see deals getting done. So as I said, this is one of many good options out there, but there's plenty of the internet makes it pretty easy. Even a free version of Crunchbase or a paid version of Crunchbase is not that expensive, particularly if you're kicking off a fundraising process. It'd be a good investment to make. I think it's like $200 a year, which in the scheme of potentially raising millions of dollars, it would be a good investment. But you could start with our janky little website.
I'd go make sure you have a look at the Airtree Angel List database as well, which has got a list of a whole lot of angel investors in Australia, most of which tell you who are active.
Sorry.
Yeah. Well, the light's going out at 5.
Yeah, I'm being told to go home to my family.
Nearing 7:30. Okay, I've got one last question, and it'll be a very quick response. What's the average time it takes 5V to do a deal from the moment you get a pitch deck? Chris?
So, as I said, diligence for us is probably to the time that we meet them to a term sheet, 4 weeks. So by which point we are we've done the bulk of our diligence. There's a couple of things certain customer calls that maybe the founders didn't want us to, there was some sensitivity. Customer calls are a big part of our process. So there may be a couple of extra things, plus some financial diligence and legal DD is left remaining. So that legal DD process, we block out a month for, because it's kind of out of our hands. So basically 2 months.
Okay, 2 months. Thank you very much. How about you, Adrian, if you're investing either personally or with the Angel Syndicate?
Yeah, so if it goes through the Angel Syndicate, normally because we take applications all the way through the time frame, but then we sort of run particular meetings. So there's a deal screening meeting, and then the full members meeting is the time where there's a pitch. Normally, I'd say it's sort of 2 to 3 months is the kind of average time frame from when they first pitch at that meeting through to basically money in the bank. I think the fastest is I think one deal got done in 4 weeks, but so that's aggressively fast. But sort of 6 to 8, but 2 to 3 months is probably the normal average at the moment from the first pitch to the members.
Fantastic. And how about you, Jo?
So the first bit where it's DD, so first meeting, to investment committee is about 4 to 6 weeks. And then from investment committee to money in the bank, depending on if it's an equity or a convertible note, could be anything from 2 to 8 weeks.
Chris Gillings, thank you very much. Adrian Bunter, thank you very much. Joanna Ng, thank you very much. Founders, thank you for joining us tonight. I hope you found it illuminating. There are a whole bunch of links in the chat, so keep it open and do some cutting and pasting to your notepad. We'd love to take any other questions you have about the topics at hand today or the Founder Institute. You'll receive a link to the recording of this session, and hopefully there will be the report that will be in your hot email box tomorrow. And maybe Adrian might be able to share some slides as well. Have a wonderful evening. If you're interested in Founder Institute, check out our website, fi.co/events. We've got another event next Tuesday. and one the week thereafter. Have a swell Tuesday evening.
Thanks, Ben.
Thanks all. See you. Bye.